G'day guys, it's Jake here. Nothing in this video is financial advice. Please do your own research when it comes to investing. Be sure to check out my links below, including exchanges I use and social media content that I post. Alright, let's go. So the topic for this video, we're going over the recent job numbers that's come out last night's important job numbers. We're anticipating a few days ago, or whatever it was, I think it was a couple of days ago when I made a video, and the very important data that would suggest the trajectory, well, going ahead and seeing if the markets will, continue bullish throughout this year and going into next year. Well, we don't know exactly the short-term moves, but the long-term trajectory and the crypto bull market as we want it to happen, and 2025 to be a bullish year. And if recession doesn't kick in by the end of this year and interrupt that, okay. So I'll just show you what we went through at the week, just a bit of a recap. So you get job openings, okay, on a Wednesday in the morning for my time, and it came better than expected, 8 million and 7.7. So well above pre-pandemic levels, which is what the Fed wanted to see. So it's quite strong. So job openings tick back up again. It was better than forecasted and consensus. So that was a good thing for the job market. But ISM manufacturing PMI was came in stronger. Well, as expected, a little bit less than forecasted, but still 47 is pretty good. And if you scroll down, we had ADP employment changes. So we had 103 from last month and 120,000 predicted, or 90,000, either. And the number coming in 143. So smashed that estimate and did very well there. So good to see that. Did get this data point, ISM manufacturing employment for September came in weaker than expected. So 44 compared to 46 from prior. And September data, of course, so monthly, and 47, and it came in lower, so that was quite weak on that front, the manufacturing employment. And we go down, and then we had jobless claims came in, it's weekly jobless claims, so it was higher than expected, okay, 220, came in a bit higher, so a little bit more, it's not as good. So mixed results so far, but mostly positive, because you had ADP well above, and then job openings well above. Those are more sort of highly weighted. If you want to look at that, data is more important. And you've got the ISM services PMI, and that came in better than expected. As you can see there, 54.9 was well above consensus and forecast. And previously, it's pretty strong in the services sector. And anything above 50 is a good economy. Anything below is bad. So we've got 55. And then we've got non-farm payrolls. Okay, this is what we're looking at. This is the source, all right? So for the last months, we got 254,000 it came in at. And it was 160 previously. And the forecast, the consensus were at 140 to 130-ish. And it destroyed it. Absolutely blew it off the charts. So that's quite positive for the job market. It's a good thing. And same time, we had unemployment rate come out September as well, and we came in at 4.1%. I did watch a Benjamin Cohen video, and he said that it came at 0.1% away from coming in at 4%. So it was close, really close to 4% unemployment rate. But nevertheless, it rounds up to 4.1, and 4.2 was previously, and everyone was predicting 4.2 to 4.3 increase or flattening. And it came in better, so it came in lower. So that's good for job markets. These two numbers are even more important than what we showed you up here. Job openings and ADP. Okay, it's more important. You see these numbers, okay, at the end of the week, and so they came in better than expected, both of them. So it's positive for the job market, and it suggests that maybe the recession is put on hold for now. We won't get a recession until probably next year or year after, depending on how this sort of plays out, that business cycle. But it's looking quite interesting And I'll show you on the charts exactly why. So I'll show you now. So we've got the unemployment rate here, and 4.1%. Okay, so this is coming down slightly. So from July, then we had end of that month, and then late August is pretty much. These are calculating September's data. That was August, and then July, of course. So it's going back a month to predict, to show what happened. It's lagging data, of course, and you can see it went from high of 4.3 to 4.1. So we've come sharply down from this, big base and push higher, and it's not quite shooting up like a parabola, and is coming back down to this trend ribbon, which is still green, so it's still not good, but nonetheless, this is coming down and normalizing, and 4.1% is still historically low unemployment rate. And if I draw a line to show you how low this is, you can see it on the dotted line anyway, and you look back in history, and 2000 got pretty low. 2019 was this low. I went around that time. Yep, 2018, and then back to the 70s, and then like mid 50s. So I really haven't gone this low very often. So it's quite good to see the labour market is historically low. So plenty of employment going out there, which is good. The economy you want to see. But as you can see, these red shaded areas are recessions. And every time you've seen, I've showed you some previous videos, set a base and it starts to shoot up. All right, the trend ribbon turns green. Recessions come shortly after that. Okay, so you go from red, right, and a base set and shoots up, and it goes recessionary. Green, red, shoots up, recession. That was the 1990 recession there. You had 1980, had a base, shoots up, recession, and then it flattened out, and then it went again. Okay, so based out and shot up again. That was another recession in the 82 period. And then we had basing out and a green trend ribbon. You had recession. You had basing out, red, and then it turned green, and then recession. And I can show it, keep going. 1960, again here, it shot up. We turned green from red, as you can see there, and that was recessionary in the late 50s. And then, the 50s there, and then the late 40s, it all played out pretty similarly. It went from red to green. All right. And then you have these periods, looks like this. See, it's a bit choppy, and you go from red to green, but it's not on a thick green line, it's only a thin, so it's not quite, it's all choppiness, so that's sort of, you got to avoid that data. Then you got this, which is more similar to what we're seeing now. So you're seeing it base out, okay. Whoops, bit of lag there. Do that again. So you see it base out like this, okay. But as it's trying to go higher, it's not. It went lower, and it turned green, but it was a false signal. That was in the early 60s. So it was a false signal here, okay. Similarly here, in the sort of mid to late 60s, 67, you had it turn green. So it went from red to green, right, and started to base out. It started to go higher, but it failed, and then it went lower, and it continued lower, okay. Then it went to 68, 69, and then eventually a bigger base was formed, and then green, and then it took off and just shot like a rocket, and then obviously a recession happened after that. But that was a false signal, nevertheless. So you had 1, 2. You don't really want to count that. That wasn't quite. This more, it's easy to see the green ribbon here was thick. This one here. So 1, 2. And we keep going, having a look. Still red there, so that was pretty interesting. And you can keep going. And that was it. So there was 2 times going back to the late 40s, okay, that we saw it. The 63 period and the 67 period that we had false signals. The unemployment rate, if you want to count this, it's 3. Every other time, it resulted in recession. So it can happen. It can fake out. Okay, I'm just showing you that there. It's not going to always play out like this. Okay, as I've showed you. So just don't discount that. Just because we've got green ribbon and it's starting to base out and starting to shoot up, doesn't mean recession's around the corner. It could come even lower. Okay, like this could come down back to here, and then lag, and then start to shoot up into 2025, into 2026. Well, 2026 is over here, so this could take a bit longer to play out. It really could do something like that. Okay, going into recession in 2026, which is what I'm thinking it's going to happen. It's going to play out into late 2025 into 2026. Okay, this is what I'm predicting because of the real estate cycle. That is something I got back into. I did sort of look at it at the start of the year and sort of shrugged it off, and then I've come back to it again. I don't know how I come across it, but I saw it somewhere and it triggered my interest again. And yeah, it's something that you got to look out for, okay? Every 18.6 years, roughly, there is a pretty bad recession. It marks the end of the business cycle. And it's like the property cycle, essentially. The land values peak out and they start to decline. And depending on where you are in the world, it can get pretty bad. 20 to 30% declines in land values. So this could play out in 2026 as this unemployment rate, if it does keep falling, okay? So that is something to keep in mind. As you can see, that we are historically low, as I showed you. We've only had the 60s period, the late 90s, 2000, the 50s, and the 40s, and the 50s. But yeah, and the 2019, we haven't gone here very often, so we are pretty historically low, and we are coming back down. And we had false signals in the past. So we had in the 60s, 63 was a false signal, as you can see there, and 67 and 50s if you want to count that as well. So there are false signals, all right? So keep that in mind. It's not perfect. So he's unemployment rate. And the SARM rule. This is another one, okay? And so it's every time it's gone above this yellow line, which is the 0.5 line, historically going back to the late 40s, as you see there. It's the same as unemployment rate. It goes back to the same time period. And you can see it's gone above it here. So that was recession. Here, recession. Here, recession. Right? Late 50s. Here was not a recession. So it was a false signal. So we had a false signal in the very late 50s. All right. Around September, October. So around the same time period as you're seeing now in 59. Then shortly after, well, still below, but recession kicked in a bit sooner. In 60, in April, recession kicked in, and that went above in about a year later. So SARM will re-triggered a year later. So it was a false signal, but then it eventually resulted in recession. Triggered here, it was a recession, 70, 75 or so for recession, 80 recession, 81, 90 recession, 2001 recession, 2007 recession, 2020 recession. And we have triggered again, but very briefly. It went above it, it poked its head above it, and now it's came back down. And we're sitting right on the 0.5 line now, okay? After this unemployment rate came out, it lower than expectations, and we could see this come back down and then eventually make its way back up. I don't know when, but that would be recessionary if it does durably break above, but it hasn't durably broken above. It's only sort of poked its head around, So it's just a slight deviation, just like we saw here, okay, in the late 50s. So this can happen. Even though the majority of the time it's played out and it's sitting recession, this has falsely triggered here. It could be playing out exactly like that now. Don't discount that at all, okay? So that's just showing you that. And the job openings, which as we've talked about before, it is declining sharply. Okay, it is pretty bad, and that's recessionary in the past. So here, 2020 was a recession. Here, 2008, 9, and then here, 2001, it was pretty bad, okay? But it hasn't resulted in recession yet. We did have a big tick up. So, yeah, these things can be a bit deceiving. Not all the time they play out. Like you think it looks so obvious, it has to happen. Like I showed the SARM rule and the unemployment rate. There are times when it doesn't happen. Okay. So yeah, just showing you that one there. We'll go to the S&P now. All right. So the S&P on the day, it resulted in a nice nearly 1% move, as you can see there. And a nice big candle, a wick, and boom. It's almost all-time highs again. Looks quite strong. I would not discount it at all. But there is a pattern playing out, okay? Keep your mind on this. Got this line that connects there. Go from the top here to where it is now. Or if you want to go from whatever that line there that connects more, it's like a rising wedge. But this thing could continue to play out and just break through it and ignore it. It's just a pattern, okay? And it's been rising up for quite a long time. And these things can go longer than you can stay solvent. As they say, I think it was John Maynard Keynes said that the markets can stay rational longer than you can stay solvent. So yeah, things can stay elevated for long periods of time. So don't discount them. And the S&P looks really strong. And I would not go bet against it just yet. As I alluded to the property cycle before, the property market doesn't look weak at all. So why would the stock market look weak? Once that starts looking weak, then the stock market can look weak. Certainly, it could be an early indicating sign that things are slowing down the economy, but not yet. And it looks so bullish, and higher lows, as you see there, is what you want to see. Okay, this structure is still playing out, and that's higher lows. All right, this can still come back down. All right, and it can still look bullish. All right, because these are big more swing lows. Okay, that's a really small, shallow pullback. So nice pullback to here, even to here, even it comes back down to there, and then goes back up into 2025, 2026. Anything can happen. So these will be welcomed, and these will be good buying opportunities. But yeah, at the moment, you can't hope and pray. You just got to take what the market gives you at the moment. So it's the S&P. NASDAQ sort of similar, but it is well below its high, so it's not as strong as the S&P. We had a bit stronger day at 1.22%. Okay, so it was a stronger day, but it's not quite as elevated as you see on the S&P is well higher. And it's significantly lower, all right? So it's not too far off its high, though. Keep clicking on it. It doesn't click properly. Go from the very top to where we are now, and we are around 3% off, okay? And if it goes up, yeah, so we are about 3% off, getting up to its high again. So it's lagging behind the S&P, but it is climbing. And yeah, it doesn't look very weak at all. It looks pretty strong. And it just looks like a big uptrend. It's on the daily time frame, of course. So, you want to see higher highs and higher lows. And this low looks like it's going to be established and push higher and head towards all-time highs. So nothing to look grim about there on the the NASDAQ. And then we have Bitcoin. That was bullish as well. So it did hold support. Went a little bit below it. Faked a lot of people out. And I draw this line from back here. Okay. And we've respected it. As you can see there, here, multiple, here nearly touched it, and now we came back to it again. So it's like a midpoint level from the very swing high peak here that we got in the March. That was the top to the swing here and the consolidation area. So this is sort of a mid-level of this range, but it is declining. See, this price action is going down in this channel, descending channel, and yeah. It still looks bullish for now. If you do push higher, we need to break this level here, okay? That's crucial. And then we can continue and head to the top of this range. But if you don't break above this high, then I'm not convinced this could be a fake out and then could come back down to the bottom of the range. Even though we've got good job numbers, inflation's heading in the right direction, economy looks like it's still holding up. It could still head down. It could be another causation for its decline. And for the short term before going up in the long term into the big bull market in 2025, 2026. So yeah, it's if you look at the bull market support band now, and we're inside it sort of thing. We're not above the SMA, but we are above the EMA. So the green line here. I'll just take these drawings off. And yeah, you can see we're heading up to the SMA. It's 63K-ish. So yeah, it is sort of in between this. And like I said, the high here has to be broken at 66,000. I can also show you something else that I found out was quite interesting. And I think it's the anchored. Yep. So if I go back If you pick a time period, you can go back to here, or whatever's favorable. And you got the volume profile here. If you go back on like a weekly chart, and it looks a bit more neater sort of thing, you can see where we are in terms of volume profile. Okay, and we are sort of in between this level. Okay, so this volume anchored profile level is very strong at around 63k, which lines up with the bull market support band there, the SMA, and slightly above it is less volume, but nevertheless it's still up here. And then we have another big peak, which is around these levels at 68k. So these levels to really look out for to break above. And then we have slightly higher than that, 69, and then the volume just starts to taper off. But we are strongly sitting here at these volume profiles. If it does fall and does not hold this 61k level, then you can see this is the lower ends shelf, which is around 56k or so. If it fails below that, then this gap area, we have a bit of a spike here. It says hold for the short term, but not a lot of volume. And we have a lot of volume lower than this, which is at 44k to 41k, right? So this is another volume shelf to indicate, along with this trend line that I've been talking about. I do see it getting revisited eventually. We'll have to see. Hopefully it does. It'd be amazing if it does. If it doesn't, then you've got to take it as it is. Unfortunate, but yeah, it's a cluster here from the ETF, Bitcoin ETF launch, and the higher lows from the bear market low to 2023 to now, and it corresponds with this volume shelf. Okay, so these is another confluence factor, and it can come back down here. I think another thing I can show you is if I go to the weekly, hang on, where are we? Inputs and the 100 week let's go to the weekly. And there it is there. So that is hovering around this level too. Okay, this is moving average as it rises with time and continues up. That would correspond to around this level, this volume profile level. So it is all matching up. So 100-week moving average is another way you can sort of look at if it's going to play it like that. It does come back down to there. Okay, so that is these levels. So you got the 51, this volume spike here, and this volume spike corresponds to this cluster and this upward sloping trend line. But we are stuck above here, this big volume shelf in this channel. So that is that. And we've got the DXY, which talked about in the previous video, and you can see that it is rallying quite sharply. This is on a weekly time frame. So you're looking very bullish there on the weekly. So nothing to be shocked by, because the US economy is still strong. Okay. Job numbers really accelerated that move. Okay, to around 102.5 now. So we came close to breaking below this support level and getting down to here, but never did happen. So we're sort of chopping sideways. And the last time it really did chop like this, it was this period here in 2015 to 2016. So we did chop, okay, and then it started an uptrend. All right, so it did form an uptrend here, like this, and then eventually it came this line and it broke down. And that was your alt season that we all know and love, okay. We had an alt season here, and that was when altcoins outperformed Bitcoin. But this uptrend had to play out first before we broke, and then eventually, went bullish. This is similar. We had an upwards trend line, okay, and then it broke. And that was alt season there, roughly. It was into 2021, so this was a bit too early, but nevertheless, it was bullish for the markets. And now we're having this sideways chop, where we get something similar, where we do see an uptrend, head up to this level here, 107. Before declining into 2026 or so. All right, it's a recession. Get something like this and this, and have an alt season before the recession kicks in 2026. Okay, somewhere around there. We don't know exactly, but yeah, that could play out as well. So that is DXY and USDT dominance. I'll finish off with, which is quite important to flip bullish. We haven't gone that way yet. So every time we touch here, December 2017, I should say, was the top of Bitcoin. And we came back to it here. That wasn't really a touch. So I don't know why I drew an arrow there. We got a touch here in 2019 to June, which is the mid-cycle top, was the top Bitcoin. February 2020, of course, before the pandemic hit. That was a top. Here, March 2021 was a top. November. Every time I touch is quite clearly the top of Bitcoin. This is USDT, so US dollars going into against Bitcoin. And its dominance. And you can see we touched in March this year. Okay, no different to previous times. And we are seeing a uptrend and continuing up. As long as this line continues to hold and push higher, this is not good for the crypto market, okay? So you want to see this break down, and that will be quite good. But yeah, this could be a top, all right? If we do break below this, this will be a first. It hasn't sort of done it since 2017. It hasn't broken below this trend line. Okay, so I do not see this happening. I do see it going higher. Okay, so more pain to come, fortunately, but the more pain you can get out and shake out people from the market, it's quite a good thing. So then it's got more room to move down. So it's bullish when it goes down, and it gives you more gains. Okay, so you want to see a big space here, a big, more room to move to the downside. So you want a bigger, better alt season than we had last time. But yeah, it has to play out first and break this trend line before it even has a chance of going down again, and that will be bullish for the markets. So that is that data. I think that is all for this video. So I hope you enjoyed this one. Just going over the unemployment rate and non-farm payrolls data just came out last night. That was quite positive for the markets. It was good. Came better than expected, which is a shock to me. I thought it would come in worse, but I've been calling for the recession at the end of this year. And then, not long ago, literally, it was within, I think it was literally a couple of weeks ago, or not even, that I rediscovered the property cycle. Okay, and I realised that we are not at the end of this cycle yet. It is into 2026, so recession can be delayed until then. So no need to get concerned and worried about the markets just yet, and they were rolling over until this period ends at 18.6 real estate cycle into 2026, roughly 2025 into 2026. There's no exact day or date or month, whatever, but it's a rough range, and that will be the top of the property cycle, and every other market will pretty much top after that or before that. We don't know, but usually stock markets top after the property cycle does. It usually the property market tops, and then it gives you a sign to be worried that because land takes the gains, as Phil Anderson says in the property market, share market economics, and that's where I got the property cycle data from. The guy pretty much he didn't invent it, but he did discover it and did thorough research on it for decades, and it has played out for 200 years. So it's very, very, very reliable. And it suggests that this current cycle is coming to an end in 2026. So there's room to move, and the jobs numbers signal that that we are not as weak as we expected, and go back to ADP numbers are better as well. So and the non-farms were amazing, well above expectations. Unemployment rate is coming down, and it looks like it's falsely triggered the SARM rule as well. The SARM rule has been triggered from previous months, a couple of months ago, and now it's starting to come back down and untrigger. So it looks like it was a false signal for this time around for 2024, as has happened in the early 60s. The SARM rule was like mid to late 50s. It happened, it falsely triggered, and then went back down again. And then literally 6 months later to a year later, it re-triggered. I believe it was a year later. Yes, it was a year later. But the recession was kicking in before then. And so it is not always correct. And the unemployment rate has falsely triggered early 60s and late 60s, and in the mid 50s or so it triggered. So there was some false signals there, and looks like we're getting one now. Okay, but it can be delayed, and eventually it will go higher. And I do think it will into 2026, which recession will kick in, but not just yet. It has to all come in, all come together to make sense with the property cycle, which I do see it's playing out. But at the end of this year, seeing the dollar is strengthening again on the back of this news and that, and yeah, this could lead to some downside for the crypto market. Just in the short term, going into 2025, I'll give you an opportunity to get in, hopefully, and yeah, the alt season will kick in once the dollar declines, and it will coincide with the property cycle as well. It needs to really drop off and fall off a cliff for it to be a proper de-dollarization and the dollar debasing and weakening against other currencies, right? And that will be in line with what happened in the previous property cycles. So that will have to come when the markets are extremely euphoric and bullish, but we are getting there. Not far off that, but I do see some weakness in the crypto market before that happens. And then 25 is really, really bullish, all right? And the USDT dominance, which I talked about, is still an uptrend. We did touch a trend line in March this year, and it's continuing higher until the USDT comes off that trend line and declines, and then we can say that old season is coming close. But yeah, as long as that keeps going up, it's not good for markets just yet. But yeah, just hold your horses. Even though the S&P and NASDAQ look like they're firing up again, crypto can lag, and it can deviate like it did in 2019. Crypto market did deviate from the stock market for a considerable amount of time, and then it caught back up. The crypto market did catch back up, and then they all declines into the pandemic recession. So yes, anything can happen. It doesn't have to be 100% correlated to the stock market, and yeah, it can deviate for a slight bit of time and trick people, and then crypto market can catch back up before the inevitable 2026 recession. So wait and see how that plays out. But yeah, I do see short-term bearish crypto, and then 2025 is going to be quite good, very, very good. And we be prepared for that to happen. And I'll be making videos along the way to guide people to make your own decisions, come up with your own strategy to prepare for this upcoming boom and bust, so don't get caught in the mania of it all, because it will be a devastating crash at the end of it. Okay, so if you like this video, please smash the like, comment your thoughts below, subscribe to stay updated. Be sure to check out my links below, and I'll catch you in the next one. Cheers.